Something very important just happened in silver, and most people completely missed it. Not because it wasn't obvious, but because they were looking at the wrong thing. While headlines were still debating whether silver was breaking down, the market quietly did the one thing that matters most in any bull cycle. It refused to break. Silver dropped. It tested support. It scared weak hands. And then, instead of collapsing, it snapped higher with force. That bounce wasn't random. It wasn't luck. And it definitely wasn't a dead cat bounce. Silver just delivered one of the most powerful technical signals you can get in a trending market. A violent rejection of key support, followed by a fast reclaim of lost ground. And let's slow this down, because this moment matters. Silver pulled back to the 50-day simple moving average, right around $75. That level isn't arbitrary. It's one of the most widely watched trend indicators on the planet. Funds watch it, algorithms watch it, institutions watch it. And in strong bull markets, the 50-day average is where corrections go to die. That's exactly what happened here. Silver touched it, hovered, tested it. And then buyers stepped in aggressively, not gradually, not cautiously, explosively. Within days, silver surged back above $81, erasing the entire bearish narrative. The so-called breakdown evaporated. And suddenly, the market looked very different. This is classic bull market behavior: painful pullbacks, sharp rebounds, and zero tolerance for sustained weakness. In other words, the trend is still intact, and that's the key takeaway most traders overlook. Bull markets don't move in straight lines. They move in waves. Impulse up, correction down, continuation higher. What we just witnessed was a textbook correction, not a reversal, a reset of momentum, a clearing of excess leverage, a test of conviction, and silver passed. Think about what didn't happen. Support didn't fail, volume didn't collapse, momentum didn't flip bearish. Instead, buyers defended $75 like it was a fortress. That tells you something important. Someone wanted silver, badly, and they weren't waiting for confirmation. They were waiting for price. This is why the rebound matters more than the pullback. Anyone can sell in fear. Only strong hands buy into weakness. Now let's talk structure, because structure is what separates noise from signal. Zoom out. Silver is still printing higher highs and higher lows. The primary uptrend remains untouched. Momentum indicators reset without rolling over, and price reclaimed critical levels faster than expected. That's not bearish, that's strength. When a market can shake off bad headlines, failed breakdowns, and heavy selling pressure, it's telling you demand is deeper than supply. And that's exactly what this bounce confirms. Now, let's talk targets. Because markets don't move randomly, they move between levels. The first level in focus is $85. That's the next major resistance zone. It's psychological, it's technical, and it's where traders will test the market again. A push into 85 would confirm that this bounce isn't T-just corrective. It's directional. Above that, $90 comes into view, not as a prediction, but as a logical extension of the trend. And here is the important part. Those targets aren't a call to being pulled out of thin air. They're based on structure, momentum, and historical behavior. Markets that reclaim broken levels quickly tend to overshoot. They don't stall, they accelerate. But none of that matters if support fails. Which brings us back to $75. That level is now the line in the sand. As long as silver holds above it on a closing basis, the bias stays bullish. Period. If 75 breaks decisively and holds below, then the story changes. But until that happens, the path of least resistance is higher. And that's the trap many traders fall into. They assume volatility means weakness. In reality, volatility is often a sign of strength being tested. Weak markets drift lower, strong markets snap back. Silver snapped back. Hard. And this is where psychology comes in. Because markets don't just move on charts, they move on emotion. The recent dip shook confidence. It triggered fear. It convinced some people the rally was over. That's exactly what corrections are designed to do. They reset sentiment before the next leg higher. And now that the market has rejected lower prices, the emotional landscape changes. Fear turns into frustration. Frustration turns into urgency. Urgency turns into momentum. That's how trends continue. So no, this bounce doesn't guarantee a straight shot to 90. Markets never promise that, but it does confirm something far more important. Silver is still in control. Buyers are still present, and the trend is still alive. In part 2, we're going to take this further. We'll talk about why technical strength like this matters even more at elevated prices, how failed breakdowns often lead to the most aggressive rallies, and what this setup tells us about where silver could be heading next, not just in days, but in the broader cycle. Because this bounce isn't just a reaction, it's a message. Now let's talk about why this bounce matters more here than it would anywhere else, because this didn't happen at $20, or $40, or even $60. It happened after silver had already delivered one of the strongest multi-month rallies in modern history. That's critical. Late-stage weakness usually looks very different. It's slow, it's grinding, it's full of failed bounces and lower highs. That is not what we're seeing. What we're seeing is persistent demand, even at elevated prices. And that tells you something about who's buying. Because casual money doesn't buy dips near all-time highs. Strong hands do. This is the phase of a bull market where the character changes. Early on, price moves because it's cheap. Later on, price moves because it's necessary. Silver is increasingly trading in that second category. When a market snaps back from a key moving average this cleanly, it signals urgency. It says buyers are afraid of missing the next leg. They're not waiting for perfect entries anymore. They're stepping in early. And that behavior compresses time. Moves that used to take months now happen in weeks, sometimes days. That's how upside accelerations are born. Now let's address something important, because there's always a temptation to overthink a clean signal. People will ask, what if this is a bull trap? What if this is just short covering? What if macro changes everything? Those questions are normal, but price already answered them. If this was a weak bounce, it would have stalled under resistance. It would have rolled over. It would have given back gains slowly. Instead, silver reclaimed 80, then 81, with speed, with volume, with conviction. That's not what trapped markets look like. That's what resolved markets look like. And there's another layer here most technical traders miss. When a market breaks down and then immediately reverses, it traps both sides. Shorts get trapped on the reversal. Late sellers get trapped on the bounce. Those positions don't disappear. They turn into fuel. Every dip becomes a forced buy. Every pause creates pressure. Every consolidation tightens the spring. This is why failed breakdowns are often more powerful than breakouts. They remove sellers permanently. Now think about where we are relative to resistance. $85 isn't just a number, it's a decision point. Above 85, the market enters what traders call open air. There's very little historical structure to slow price down. And when markets enter open air, volatility increases, ranges expand, momentum feeds on itself. That doesn't mean straight up, it means fast and emotional. And that's where discipline becomes more important than prediction. Because in environments like this, the biggest mistakes come from doing too much. Over-trading, over-leveraging, chasing candles. Strong trends reward patience. Weak hands get shaken out by noise. Which brings us back to support. $75 is still the anchor. As long as price respects it, the trend remains valid. That gives you structure. That gives you clarity. That gives you a framework instead of fear. Too many people try to trade headlines, or opinions, or predictions. Price already did the work for us. It tested support. It rejected it. It reclaimed trend. That's the information. Everything else is commentary. Now zoom out again. Because silver doesn't trade in isolation. Gold is strong. Real assets are bid. Volatility is elevated. Liquidity is uneven. This is the kind of environment where trend continuation is far more common than reversal. And silver, by nature, exaggerates whatever environment it's in. When things go quiet, it underperforms. When momentum builds, it overperforms. That's why these bounces matter so much. They're early warnings of acceleration. So what's the takeaway? Silver didn't just survive a pullback. It used it. Used it to reset momentum. Used it to flush leverage. Used it to reassert control. That's not weakness. That's preparation. And the market doesn't prepare for nothing. Whether the next move pauses at 85 or overshoots toward 90 or chops sideways first, the structure tells us one thing clearly. The bull case is intact. And until price proves otherwise, the benefit of the doubt belongs to the trend. Because in markets like this, the biggest risk isn't being wrong, it's being early. And then giving up right before the move actually happens. Stay focused, stay disciplined, watch the levels, ignore the noise. Silver just reminded everyone, this market is still very much alive.